Big Reed.
Yeah.
What? Sketch? A squid? I like the line. No, it sounds so funny.
Hello, guys.
I love the, like.
Remember that your microphones are on, guys. If you're not going to be participating in the moment, please mute yourselves. If not, I'll be muting you.
Rapidly around the world are significant. That's why you see companies investing heavily to create this opportunity.
So you said your company is built for it. But then last quarter, stock sold off on the.
I'm muting everyone at the moment. Hello, guys. How are you? How's everything going? Where's the chat? Let's go. Vini, how are you? Rudy? I have voice again. The fluid's over. We're gonna wait just a couple of minutes until 8:05 and we start. I'm gonna talk a little bit about hedging, and seems like a good moment. The market is so over the stretch right now and keep going up that, this is a good time to start thinking of if in any time we're gonna have any reversal on the market, we might have started to how to protect our portfolios. So hedging is gonna be one good way to do that. We're gonna talk about definitions. We're gonna talk about some samples, and then we can open the conversation to talk. There's not much that I can show on the charts on this, but we can talk about positions and what I see and what I look on the contracts to use for hedging. How was everyone's day today? You can use the chat to write, please. So there's not gonna be too much people talking, but it was an amazing day on SPY and some of the shares. Will anyone on VC trading with us? We've traded Tesla, we traded Apple at open, SPX several times. We traded Morgan Stanley. That's a fun day today. A lot of opportunities. Of course, I got someone telling me that if we left, like he was having trouble leaving too much profits on the table and trying to get too fast. But remember, we just no one's gonna grab the whole move. We're just trying to get a little piece of the movement. And today was a huge move. So, and we were on new territory, so we never knew when is the top. So we're just trying to grab money when you see it, grab your profits and protect whatever your position is. So it's really hard. It's really easy to say when you see they move on the chart afterwards, like, oh, look at that. But it's really hard to do it when there's nothing there. So don't blame yourself. Don't be too hard on yourself, guys. Remember that sometimes with 4 or 3 5-minute candles, that should be our trade for the day. It burned you, Rudy. A bit at the end of the day in BC, just 1%. Yeah, listen. Sometimes it's tricky to play SPX, guys. I don't recommend it all the time. You gotta be pretty fast. You gotta know. You gotta be, pretty cold to let it run. SPY was a great trade today. Just, Apple contracts paid amazingly. The 218s, they paid around 218%. So from the entry, I don't know if any of you saw it, but I shared this morning the chart on Apple, and I shared the trend line on where we needed to entry. I didn't call it because Sapes call it and Flips call it, so I didn't want to overlay on the same contract, but I'll show it to you on the later on the charts. The entry was on point, not because I said it, just because the price action said that it was at that point. But let's start, guys. Thank you for being here. Thank you for sharing. we're gonna talk a little bit about hedging, and let's start with basic concepts just for everyone. I have to start here because we are hedging with, I'm not talking yet about shares, it's gonna be about options. So this is just, basic what the options concepts are. It's just a financial derivative that's provide the right, but not the obligation, and this is key, not the obligation to buy or sell an asset. Why do I want it to go back here? Because this is a key concept that we can use when we are hedging, because we have different techniques on how to hedge that is gonna help us use that obligation that we don't have, but we can exercise when we do some hedging. And that's gonna be key for some exercise and examples. We have our call options. This is just a general. I know this is very basic. Just reminding you guys. Call options, we buy an asset to go up. Put option, if we're given the asset to sell to someone. We buy put options, we buy call options, we can sell call options, and we can sell put options. So just wanted to touch a little bit on these basic concepts, because we part of being a how to hedge is gonna be how to use these contracts, and either we buy it or we sell them, or we use them both at the same time. The key terms: strike price, expiration date, and premium. Premium is gonna be important here because the premium is gonna be part of our cost to hedge. So I just wanted to put it here to add basic information. I don't know if anyone's new here. I don't know, but always raise your hand if it's someone new, and we can, try to not underestimate that sometimes it is the first time that someone sees all of this. So hedging is just a strategy that we use to offset potential losses in a position that we're taking by an opposite position that it's related to the asset. The easiest way to talk about this is if we buy 100 shares of X, and our position is going to be great while the market is going up. But if the market start going the other way and we don't want to get rid of our position, we use the hedge, and we can buy options against that position to offset what the market is doing. And we will go into some examples on how do we do this and how to do it. So the purpose is to protect our investment against whatever happens to the market. Why do we protect it? Because sometimes we hold longer terms, or we want to short it, like what was happening with GME and AMC, where people shorting those move, and they were thinking that the thing was going to crash down, and then it went up, and they needed to cover their positions, and that's when the prices go up, and that's when Roaring Kitty started making more money and more money. One of the other purposes of the hedging is to reduce our volatility and the risk on our position. Why? Because we can buy up or down, and we can hedge to contrast or to balance whatever is happening on the market. And we can stabilize returns. Why? We will go to that sample. Like, we can make some of the money that we're losing in our long-term position by hedging. We talk about this a little bit when we were touching the class on leaps. Leaps could be hedges that we use for our long-term position. So there is an amount of different instruments and tools that we can use on trading, and for hedging there's no different. Like, we can buy shares against other ones, we can short some shares against a position, but mainly, since we are on the options, we talk about how do we do it with options. So examples: normally hedging a stock portfolio with index options. We can if we have a heavily technology port that we have right now, we can always hedge with some Qs. So we can have puts, we can buy puts on QQQ, and thus hedge our, if we have Tesla, we have Nvidia, we have TSM, we have Meta, we have Facebook, all of those, we can try to hedge it with Q puts. And the idea is that the Q puts are gonna pay for the downside that your not making money on your position, and it is gonna offset the balance. And then commodity prices, if you want, if you're playing futures. Sorry. Why we hedge with options? Well, options have the flexibility that can be tailored to meet specific hedging needs. We can tailor the prices. We can use the different ticker names depending on the prices that we're hedging. We have the time frames that we want. Sometimes you can use SPY puts for 3-4 days. You can, we have everyday expiration, same with Qs. So you can very, very customize your portfolio and your and how do you want to hedge it. Hey, Norberto, welcome here. We can limit the risk. By hedging with options, we know how much are we putting, because the only thing that we're going to lose is whatever we're paying in the premium. So it's very good to know, like, whatever you have 100 shares of Apple and the markets, like right now we are, in the highs normally, and well, I'm betting that if it's going to go to 220, sometimes someone is going to start hedging for that position in Apple. I'm a holder of shares, and I don't want to, every time that I can and I have some gains, I buy more shares. So if I want to, one of the options that I have is I can buy either QQQ puts, or I can buy some Apple puts just to hedge. Or you can actually, there's something that you need to realize, guys. You don't need to buy the same name or anything. You can do any other name on the inverse because you think that it's coming down. I can hedge my Apple calls with BA puts, since BA is having bad news and I think it's going to come down. Maybe that's the decision that I take. But normally we will do it against the same market and the same name, or against a ETF, because the ETFs, it's more broader, the amount of shares that they cover, so it's easier just to use it that way. And for income generation, why? Because by sell it, we can sell cover calls and generate additional income. So we just sell and we get whatever the premium is. And if we don't care, if we get into a position and I buy Apple, and my price on Apple was, I bought them at $130. And right now we're at 218, and I don't care. I only have 100 shares. I don't care, and I don't need to I'd rather have that money and just switch it to JPM that, banks are starting to go up. So maybe I just want to rotate my position. I can sell calls, or I can sell the, I don't know, let's say 218s, 220s, or whatever the price I wanted. Let's say that yesterday or last week, I sell the 215s or 218s. And if today the 218 came, I don't care that they take my position away. I made money from 130 to 218. And now I have that money plus the premium that they pay me to now rotate my position and get into another, that's one of the things that we do on your long-term portfolio. You want to have rotation. You have certain names that you keep, and you keep some of them, you keep them forever. But the other names that you can have them just, transitional. Like, if I buy, let's say, I don't know, chips right now. And we have, like right now, it's everything AI related is huge. But before this, anything that it was NFT related was huge. And everyone's buying everything crypto related and NFT related. And we have all these crazy names that everyone were never heard before, but they were rallying and we were buying it. So rotational. Now, I don't know if NVIDIA and TSM are gonna, be running forever like this. There might be a moment that they're gonna stall a little, and they're gonna come another names on other things, EV names, battery names, mineral names that we're gonna need for extra energy for, I don't know, air. Sorry. And we can just, move that money to other names. So that's one of the ways why we use it. So now we're going to talk about some strategies. So basic strategies. This is nothing complex. We don't gonna go into, do you hedge for ER, Vinny? No, I don't hedge for ER. Sometimes people will buy a put and a call and a name, try to do a sort of a little straddle or strangle, but it depends, because if you don't buy it at the money, or 3 ticks close to in the money, sometimes what happens is that both your put and your call just get crushed by IV. So I don't like to do that on ER, on the earnings. I rather just, if my rule on earnings is, if I'm green on the day and I don't care about sacrificing a little bit of that profits, I will play my earnings. If I'm not green on the day or I'm barely break even, I don't play whatever. I don't care what earnings it is. I don't play it, because that's money that it can go either way, and I don't want to risk it. It's up to you. There's some people that only like to play, ERs, and they go very heavy. But the truth is that we don't know what the companies are gonna announce on that day, and if they're gonna buy back, shares, and they talk about any kind of things that we don't know. Look at ANF. ANF is one of those names like Abercrombie and Fitch that no one really traded. No one. It was like burnout. And look at how that turned around as a retail share. It's an amazing move that they have done the whole year and last year. So. And Lulu, which is a premium name, it's coming down. So you got to be careful with that. But yep, no, I don't do it on ERs, meaning. So basic strategies, guys. I'm going to talk about 3 of them, but right now, protective puts or cover calls. The protective put is the most common one, and it's buying a put option to protect against a declined price of an asset. That's what we talked about. If I have 100 shares of whatever name, let's say that it's a X name. If I buy 100 shares at $50, I can buy a put option with a 48 strike price. And if the stock falls below 48, the put option, the gains of that put option is going to offset the losses that I'm going to have on my position. So I will take my position, I will sell my put options, and then I will buy either more shares to average down my position, or I just leave it there and I use that money to another position. So that's an easy way to do it. A cover call, it's selling a call on an asset that you want to generate income. That's the example that I was talking about. If I own 100 shares of X stock at 50, and I can sell a call option with a 55 strike price, I can sell the call options. I'm not buying it. Sorry, guys. Still have a little bit of that coughing. So what am I getting if I sell that cover call option? I'm receiving the premium for that, the amount of that contract. And if the stock goes above 55, I'm selling my whole position at 55. So I bought it at 50, and I will sell my 100 shares at 55, and I get the premium out of it. So I do that if I don't care about that position, and it's just, itinerary. That's something that I bought just to make profits, and I'm out. You can always do that. Or some people, if you have a very, very, very low price and the option is going hugely up, you can just sell, a little bit out of the money and just generate that, make out of that premium. There are some people, I know some guys that they have their portfolios just SPY. They have, I don't know, 3 million on SPY. They're being only buying SPY the whole life. And the only thing that they do extra is they sell call options against their portfolio. And that's how they make money, because their price is so cheap that they can always sell against, and they're never going to be called. So it's a great strategy to have. That will be my dream portfolio, just having like QQQ and SPY. That's it. And the other strategy that we can talk about, if you're new on this, it's a married put. So to get a married put, you buy the 100 shares of X stock at 50, and then you buy the put at the same time with a 48 strike price. So I'm just protecting against the downside while allowing the upside potential. So this is if you're getting into that new position right away, I'm marrying my position to that put option at a lower price. So those are going to go hand by hand. Probably you buy for a long term, the expiration of that put price, and they will go up or down together. And you can buy several. You can buy, but normally it's one because that's 100. It's 100 shares, but that's a way to do it. So a little bit more advanced techniques to hedge. We have the color strategy, buying a protected put and selling a covered call simultaneously. It's normally I don't get that this complex and I don't do this, but you can buy 100 shares of X stock at 50. You buy a put option with a 48 strike like before, but then you add and you sell another call option with a 55 strike. So this, what it's doing, it's limiting both the downside and the upside potential. So you're covering, sorry, if it goes down or if it goes up. So you can sell any of those, either the put or the complete position if the occasion arrives. So it's I don't see this to be that common normally, but I don't go into complex strategies with options. Options can go as complex as you want it, and it's really in depth. But I like to do it, to keep it to the basics. My portfolio is not that huge, so it's easy to manage. A calendar spread, which is another a little more advanced option to hedge, or another strategy, is you buy and you sell options with different expiration dates. So you buy a longer term call with a 50 strike price, and then you sell a shorter term call option with the same strike price. So if I buy I don't know, 2 weeks in advance call option for the 50 strike, and then I sell this week's 50 strike, and then you profit from the time decay and the volatility on the changes between those prices, and then you sell the whole position and you can make money on a butterfly. Yep, it's sort of a butterfly. This could be the spreads, this could be the butterflies, the iron condors, but that's why you're hedging against a position that you're buying. We talk about this also in the leaps. Leaps, you can do a synthetic hedging. You can buy a position, you can buy 100 shares of, you can buy a call of I don't know, XPY, and you can actually hedge against your call. Since you haven't exercised that contract, you own, between quotes, that position, and then you can hedge against that one. So you can buy a 1 year leap on SPY and then keep on hedging against that contract until you need to either cover it or you just want to sell it. That's called a synthetic position, synthetic leap. And then we have the ratio spread. A ratio spread, it's buying a certain number of options and selling different numbers of options. So if you buy a 1 call option at 50, I can sell 2 call options at a 55 strike price. So the strategy, it's profits from that moderate price movement. So it's going to be 1 against 2. I will make more money. One on one is going to protect itself. And then if the movement goes your way, you will still make money on the left contract that you have on the option. So as you see, this is not as complex, but it's really important that we do it and we know how to do it, because sometimes when we only day trade our puts and our calls, but we don't use them as a protection for other positions that we have. So you see sometimes dealers saying, "Oh, I'm buying puts just as a hedge of my contract because the market's coming down." And then how do you decide which ones you need, or how do you do it? And we're gonna talk a little bit about that. So what's a practical application? So we have to identify the asset. Why do I need to hedge? Am I hedging my apples? Am I hedging my SPY? Am I hedging my I don't know, my Carvana that it went up and down in 2 years, like $200. So you got to select the options that are appropriate options based on your risk and tolerance. So if I have a Apple contract or Apple shares, and I'm thinking that my Apple price is going to go to 200, I'm not going to buy a put option that is going to be at 340. I'm not doing anything. You need to try to see your chart and your levels and try to see where a valid price action is going to go, so that it's gonna work your hedge. So you have to execute the trade, you have to select the option, you have to monitor it, you have to adjust it if you can. You can always move it, you can always sell it and then buy it again. And then again, let's go to a simple scenario, which is 100 shares of X stock at 50. You can buy a put option at 48 strike price. If the stock drops to 45, the put option is gonna offset the loss, setting a floor at 48. There's other ways how we can do this. Like if we can talk about if I'm short in the market and I'm buying a call option, and if the price goes against me, I can, and I bought that call option as a hedge because I'm short in it, I can exercise the call options if they're at a certain price, buy the shares and offset the loss that I have to pay for the shorting that I did. So I'm just gonna repeat that a little bit. If we are shorting and the price go against us, you can do a naked short, and then I have to pay whatever the price is at a certain time. So if I'm hedging the same 100 shares at 50 and it goes to 65, I will have to pay that, $6,500 that I have to pay because it went the other way. But if I buy a call option at 65 and the price goes to 65, I can sell the call option. I can exercise the call option, buy it at 65, and then my loss is going to be the difference only of $15 on those 100 shares. It's not going to be the whole 65. So that's a way to protect yourself also if you're shorting. So we can hedge on the way up, we can hedge on the way down. Any questions so far until here, guys? I know this is not as fun as going to the charts. We can go to the charts later and talk a little bit about some positions and some prices and action, but it's really, this is more practical in definition and how do we use them, and then we can talk about which contracts and how do we choose the contracts to offset it. But no questions here in the chat? Anyone? Nope. All right. So again, this is the purpose. How do we hedge a stock portfolio with the index options? We can commodity prices, risk management, diversification, the spreads. This is nothing that we can just jump around because not much interest here. We talk about this. All right. I'm gonna jump to some charts, guys. So let's have some fun. Let me just stop sharing here. And let's share this. So I just want to make sure. Can everyone see the chart? Please let me know in the chat. Meeting chat working? Oh, yes. Is everyone in? Is anyone having trouble with the chat? I can't read the chat for some reason.
We can see Empanada. We can see chart.
Okay, I don't see the chat, so sorry guys. I don't know what's happening, but I can read the chat. So just feel free to talk and unmute yourself. So this is what I'm gonna do here. This is my normal, this is today's Apple that we were talking about. And imagine I'm gonna extend this. I'm gonna go to the 1 hour. So look at the move that Apple had on the last 2 weeks. Last week. So this is today, Friday, Thursday, Wednesday, and Tuesday. If I have a position here and I'm building up my position in Apple, this is all-time highs. I got two options. Either I'm gonna it's gonna keep going up, or this is gonna be a double top here. So I can do something like this. see what's gonna happen on the pre-market and until Friday. But if I'm gonna protect myself, and let's say that I have 100 shares of Apple, where do I see Apple coming back? Normally, this is my extension. I'm gonna go to the 4 hours to show you a little more. Sorry about it. I know it's a little crowded, but look where Apple bounced. I love to use as usual in all my lectures, you go to my longer term charts and I use these blue lines, it's the 20 daily SMA. 20 daily SMA, I use the 20, the 50, the 100, and the 200. Normally they will go in order, 20, 50, 100, and 200. And look where the 20 was up, we got Apple down, and then look at the 20 coming up, and crossing all of these. This is the 50, 100, 200, and going up. It touched here, and we got a beautiful bounce out of the 20 daily SMA. Amazing bounce. We had it here again, and here we had it up and down. We hold it up again, touch it here. So I'm looking for another touch of this guy here somewhere. If this can come down, this can go up, but it looks pretty good so far. So if I go to the 1 hour, I think that it can go a little down. Like I don't mind Apple coming to probably this area here around 205. That's an area that I think Apple can come back. And let's just check something on the weekly. You see, look at this. We went back twice to 200, sort of this point. So I won't be surprised to try to see this back again somewhere. But let's grab some more time. 10 years, yeah, nothing. All-time highs. So this is where we are. These look great bull flag. But let's say that for the purposes of hedging today, that I think it's going to come around here. So what can I do? What's the time frame that I think this thing is going to come down? If, in my opinion, if we're coming down here, it's going to be between the end of this week and next week. So I can buy. What I can try to do is, let's try to go to my options. I can go maybe to July 19th. So what are we looking at again? So we were looking for somewhere around this area, 205, 207. So I will grab something like this. I will go to, I can buy for 150 bucks. I can protect my 100 shares of Apple. And why do I like this? First, it's really close to the money, to be in the money. Two, look at I use volume and open interest on my choices. That's how I choose my contracts. I go for the volume and the open interest. Open interest is the amount of contracts that are open and actively right now on any of these prices, and the volume is the amount of contracts that were moved today. They reset normally daily, so we can see how they go up and down normally. So I like these contracts. They are very liquid. Got a lot of holders here, and look at they're even more here, 50,000 open contracts here. But for the protection, and if we could come down to 205, this is gonna go in the money pretty fast. So look at here is 150, 250, 430. Look how it jumps. So if my contracts are from 150 to, let's say, 400, and my position goes from 100 shares at 200, so it's gonna jump pretty fast to offset whatever losses I have on just these 10 points of my position that's gonna come down. So this is gonna be like, I don't know, 300 bucks or maybe 2,000 bucks coming down here. And if I buy my shares, that's gonna make me maybe 600 bucks. So I'm offsetting whatever we're coming down on that place. So that's one of the uses of why do we buy those contracts. And it's important, guys. I use my levels to see where I think if we come down, we're gonna go down, and that's where I decide where my prices are, because it's a lot easier to go here and just go like, let's see which one I can afford. I can afford this one because it's 23 bucks. Let's buy this one. No, it needs to make sense. It needs to try to see like what you're doing, and it needs to go hand in hand with what your actual price action sees on the chart. So that's why you want to go into some of these ones with the more, the prices make sense on our charts. Let's see, what else do we got here? So what else moved? Today we got a huge move on Microsoft. So look at the move in Microsoft from perfectly level to level. Look at that. Sorry. So look at this movement on Microsoft. Again, you bought shares, or you are in maybe you are, let's say that you're in a leap, and you bought the leap. Again, look at the hold on the 20 daily SMA. Look at it, breaks, hold, and then breaks up. Look at this break, a little break, and then here when we're finding, rejection. Now rejection becomes support, and support comes here. So now we're gonna start trading on. We had this block. We had this block. And now we're gonna start trading on this block. So the question for tomorrow is, this is nice up, start stepping up. Are we gonna hold here and try to go find another step, or are we gonna hold? And if you see too many holds here, I'm probably gonna try to buy a put to go to here. So, but if you are long and you're on leaps, how do you hedge this? Because I don't want to get rid of my position, but in case that we have a little, pull back to 443, what do? I will buy probably some puts. And I know that my price is going to be around 443. I can go maybe a 442. So I go here, let's say I got 3 weeks, 442, 443. So my choices are going to be either this one or this one, 10 bucks difference. In this two. And this is where I need to hedge. Why? Because it's 400 bucks. Yeah, but how much is my position here? If I'm in 100 shares, I'm in 45,000 bucks here. So it's not that much when you think about that, right? So this is how we try to find which prices are we looking for. And then it's just as a protection. If you see the price action coming here, then you are in 100 shares at 450, and you go to 454, 455, you just put a stop loss at your hedge, and you lose certain money. Maybe you lose 200 bucks, but you're making those 200 bucks on your 100 shares going up. So it doesn't matter. Like normally hedges are made to either make some money or to be lost. So not necessarily all of them are to make money. It's just a protection. So you gotta be ready for that. The idea is that your longer position is gonna make up for that loss. So anyone is hedging is using hedges right now. I don't know why I can't see the chat at all. Just
Hello, Empanada. I got a question.
yeah, Norberto, what's up?
So you're saying
Sorry.
like since everything's been parabolic, all-time highs and everything, you're saying that the next move would be a down move as a hedge, right?
No, I'm not saying that the next move, but how do you, like, if you're in a long position, if a stall on this move starts to happen, I would like to protect myself. And the hedge doesn't need to, I'm just going to do it as a precaution, because I don't want to lose money. If, remember, we've been going up, but we can come down pretty fast. Normally, if we go stairs up, firefighter tube down. So how do you
Yeah.
protect yourself when you're right here? Let's say that you are on Nvidia. Let's make a better. You are the holder of 100 shares of Nvidia. Look at this. And you bought your shares at 97, and you are at 133. What do? You wait that the thing is just gonna go to 2000, or if you see this trying to break, but rejecting, won't you think that this thing is gonna come maybe here or maybe here? But are you gonna sell your shares right here? Or you want to keep holding your 93, or maybe, remember, this is 973. So some people bought this at 10 last year. At the beginning of last year, this thing was at, look, even 40 looks, this is $400. And look at this monstrous move. So if you have shares at 40, are you going to sell it here? Because I'll be
Obviously
buying
not.
all this move up. So how do you protect your position to just leave that position here?
Obviously, like buy like a 3 months out put
Okay.
option, and then obviously if that move does come down, buy the dip. Well, isn't that ideal?
Yeah, that's perfect. That's why we hedge, because I don't want to get rid of my $40 calls because I have 300 of them, but I don't want to lose money if we come down. So what do I do here? I buy puts. Maybe let's say we can even do this. I have 400 shares at 40 of Nvidia, and I don't mind selling 100. I can sell some either calls or I can sell puts. And if it goes down, I can get rid of 100 of those shares that I bought, plus making money on the premium that I sold. And I will make money on the premium. I will make money on the price that I sell it, because I'm selling that put. And then I just get rid of 100 shares and I cover for whatever the down price of my rest of my 300 shares did. But more like, ideal is that I keep my 400 shares. I sell, I don't know, 3 contracts of, SPY of QQQ, let's say, because it's Nvidia, and I sell some of those like really expensive Qs for, 4 months in advance or anything like that, and with a 122 strike price. So I sell them here, and when we're here with the money that I made out of this, I buy more shares on the Qs to average the price down. And then you buy again your position you keep on holding your Nvidia position. That's ideal. So that's why we use them, guys. They're a great tool. You can use them in different ways depending if you want to hold or not the position. You can make it, as I say, if you bought let's say that you bought 2 calls of Nvidia here, and you don't have the money to buy, the shares, you can sell the shares. But if you're a long-term holder, you can sell calls against this position here, or you can sell, premium against this move up while you are the holder of that call option. So I invite you to go to paper trade on either of the platforms that you hold and play around with this. Buy don't buy 10,000 SPX because you have $100,000 that you can buy. No, get rid of everything. Buy 1 call of Nvidia and then sell a call of Nvidia against it. Then sell a put, then buy a put. So do the different strategies, see how they work, see how they move. Like, when we are between trades, just, let your trading go. Just jump to paper trade and practice. Because remember, as I said the other day in trading psychology, one of the first problems that we have as a traders is have you seen a tennis player like grabbing a racket and going to a Grand Slam the first time that they are in and play against, I don't know, Nadal for the first time on their first game? No, that guy has to play and train for the last 10 years to probably get there, or maybe Carlitos Alcaraz, that he's a phenomenon. phenomenon that, you know, this guy can go and do that, but he's been practicing his whole 20 years that he has. But what do we do as a traders? Well, we have $5,000. We just put it on an account. We jump into Webull and we decide to, I'm gonna be a options trader. How? Well, I buy and trade because it says, click here, click there. That's it. And then I'm frustrated because I'm losing money. I don't know what's happening. Why am I losing money when Flipped is making, you know, SPX every day? Fuck, I don't know what's happening. Well, maybe you don't have the training and you haven't done all the expertise and you know, you need to practice. We need to do tons of paper trade and practice and see how the markets move, how the different strategies move, and which one is the strategy that you feel more comfortable that which one is the one that you can identify. So go to paper trade, guys, and you know, buy one call option of Nvidia, buy a January 25th 2025 Nvidia, and sell a call against it, then get rid of that one, then buy a put against it, then sell a put against. See how that works. See how they move together in a couple of days and study how that works. So when you come to real life, you can actually know what you're going to do. And the same with these indicators and everything. We need to practice. We have the bad habit to jump into the market to practice with our real money. And you know what? We lose it. We lose it. So you got to be really careful with that, guys. Please. So go to paper trade and practice, please. And hedge. Buy 200 shares of whatever you like and hedge against it. Sell calls, sell puts, buy puts. See how that works. And then do that on Webull or in TOS. Don't do it for the first time in Webull and then you're like, oh, I don't know what's happening. It's going up, it's going down. We need to practice. We need to practice, to practice, to practice. Don't wait the whole day to just trade. Grab, you know, open between 9:30 and 11, and then take a couple of hours and paper trade while you are in live market and see how that goes. And then go back to power hour and trade. Sorry for this. This is not a rant. This is just an advice. But this is the best way to see how these contracts and all of these work. And it's really cool because you actually see how all of those hedges and what happened when I sell puts and what happened when I do a straddle and when I do this or the other. Play around with that, guys. Sorry, guys, I can't read the chat. I don't know what's happening. I'm gonna stop sharing. I'm gonna do it again. See if I can see the.
Yo, Empanada, I was gonna ask you a question.
Yeah.
If you have time, you think
Yeah.
you could check Marvel and Dell?
Dell, you're grabbing
looking at-
Eva Panda call.
150s. I'm looking at the 150s, and for Marvel, I'm looking at the 74s.
Well, look at this. This is interesting. I like Dell. Dell, when it's been going amazingly until here. They had these earnings that they went bad, but besides that, they were doing amazingly all the time. And I have my 20 daily SMA. Look where we rejected today. So this is key. I saw the call on Eva today, and I don't know what she uses, if she uses this or not, but as for my indicator, for me, if I see this, I mean, for me, it will be an early entry because it's not on top of the 20 daily SMA, sorry. For me, this thing needs to be on top. This is on the 15 minutes. For me, I need to see, for the way I trade and how I use these indicators, look, this is a perfect rejection here. I would like to see the pre-market tomorrow or tonight going up here and staying here, and it's going to be valid. If we don't see the break here, or we don't see it tomorrow, I'll be careful. But if we see the break, we have an open. You see that I have an alarm here. I set up a alarm here an alert to see if this goes a little higher to my next level. So I can go to the 1 hour, and then you have free all these gap to go. Yeah, this will be my first trade here. So I mean, this will be my first, second, third, fourth, all the way up. But I'll be careful with this. Pay attention to this. This is the 20 daily SMA, and it's a big resistance. But it held the 50. This is the 50. So I won't be surprised if we see tomorrow this breaking up and try to go up. So, and Marvel, I haven't been trading Marvel that much lately, and this is what I got. I'm gonna get some more days here. Let's see what we got. Yeah, same scenario. Look, we bounce on the 20 here, bounce on the 20, beautiful bounce on the 20. Then we went straight down, broke it, stay above. We broke the 50 and the 100, stay above, rejection. Then again, broke it up. And we're trying to see if we're gonna hold it, but we're not there yet. So same thing as Dell. I want to see a hold above this. If not, this could be a double top, sort of like kind of maybe not really clear, but top and then come down all the way back towards here. Your first
You check
target.
Visa,
Which one?
Visa.
Visa. There's Visa.
Thank you, Empanada. I appreciate it, man.
Yeah. Be careful with that 20 daily. Just add it to your longer term. Look, I had Visa charted like this. Huge trend line, like ting. We are here now this range. Now we open it up a little bit. So I got this new range here, up and down. So it could be nice if you want to try to get here to go again to 80, but this is what we're doing in the last couple of weeks. I mean, if I grab more days, this is the last 180 days. Look, we're stuck here. Ting. We're not doing anything. It would be nice to go up, break, and break up again to 290. But if you want to trade the range, we just broke it a little bit lower, and this was the break down. See, up, down, and up. You're out. Then you're again. It's fairly easy to trade. And if you trade here and you grab puts and it breaks, you put your stop loss 10% out. But same here. You want to grab this tomorrow, 10%, or maybe here at 268, and then up.
Can you check a last one for me? BRT. I seen a lot of call flow for this Friday expiration. The 91s. I saw like 3 million.
91, it will be right here, somewhere around here. So yeah, well, it's interesting the same, because in my longer term, it was finding resistance. It find resistance today on this 50. So look, on the pre-market between Friday and on Thursday and Friday, it went down. It found huge resistance on the 20. So look how I look this, how I'll read this. We were trading above the 20, went down. This was just a look below, look, perfect bounce on the 50 daily, went up, hold it, went stay above, and then we broke it again, push back. We tried to hold the 50 again. We couldn't. Now another look down, resistance. So I'll be really careful with this, because I don't, even though the flow could be very high, it has to break the 50 and break the 20. So it has a lot of resistance on the way up too. I mean, look at the 91, it's below that, but you gotta be careful with those levels.
Would you check Levi's?
Is that viral?
Yeah,
What's up, guy? How are you?
I'm pretty good.
So you ace it today. Look at this. Look at this. Beautiful. move today. Broke the 20. It tried to hold it, stay, and broke it, and now it's below above. So I will look to hold around this area tomorrow and then try to go to this higher level around here.
Yeah, I added around 22 when it got the pretty good high couple of days back above daily SMA, and then I did average and still holding. So now it's paying better.
Let me see on the, this will be with my cloud. See with the cloud, look at the extension, somebody will ask me today, how do I know to stay in a contract or stay in a move? The cloud, the Ripster cloud, it's a great tool. If you see the extension and maintain the extension, you don't see that they're crossing, I won't stop out of the trade. Here is where I will get out of this trade. When you see this is the 9 and the 10 and the 20. When the 10 crosses above the 20, that's where I'll go out. But when you see the 10 crossing the 20 and holding this cloud all the time, and you don't have any weak breaking up below the 20, I'll keep holding, holding. Maybe here will be an out, but this is really nice.
This is like NF. It's keep going from, if you see daily chart, it's a long time. It's keep going.
Here's a nice bull flag here. Hold. What else do we have in this? Oh, look at this.
I took a little nice trade on ARM today. Pretty much at open. I saw that it was holding resistance, and I hit the 165s for a day trade, and they pay like 50%.
Yeah, ARM, look at ARM where it is. Your all-time highs again. You want to see if these things. Now you gotta be careful with these two levels. If you see a retrace here, I will buy calls. Whoop, to try to go high. If you see it trying to, if it doesn't break 163.89 and try to go to all-time high again and above, I'll be careful. I'm gonna redraw this channel, and I'm gonna do it like this from this point here. I can use it here.
Yeah, people are upgrading that stock like crazy. I think upgraded 40 to 180, 150 to I think 170. So it gets on getting upgraded. So I mean, I don't know. It's a pretty crazy company.
This is what I'll be looking. This will be my next levels up. That's how I look when we don't have any levels up, that's what I'd use. And I try to guide myself with this. It looks pretty good, but be careful tomorrow with this rejection. If it goes above and stays above, you're flying. Try to use your extension. You know, there's another way on how to measure this, which is old-fashioned, but people used it a long time ago. If you just go here, try to make a trend line, and you see that it's 877%. So then you just go here to 877%. Around here. And that's where you sort of put your next move. It will be somewhere around from here to here to here. So you know that this move is going to be equal to this move. and in between you can, you know, be careful on how you're gonna trade
I
it.
was
But
also I was also looking at a SPY for Friday expiration, the 550s. I wouldn't enter now since we got a big move up today, but I would like to see a little pullback, and I would pull the trigger on those.
well, I bought SPY puts today at the end of the day, just in case we have a little pullback. And then this is how I traded today. I had this on.
I'm looking at the 544s for the pullback.
I had this, and tomorrow morning I will change these for actual levels, and I will set more levels up. So I just want to see how this works. You see, 100 here, another trace here. Look how it went all the way up, retrace back to 261. It works pretty well.
So what was the big pump today? What was the news, or well, or
I
just
I
everything
have
flying?
no clue. I have no clue. I need to read about it. I was preparing the class today, but I have no clue because I was here talking with Flips, and all of a sudden the thing just started going up, and we were training SPX on this, so I was like sweating. I was like, what the hell is happening? Look at this. We were on the 5 minutes, and if you see, and you see SPY, when these things start going up, all these huge candles, like candle, 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 we're like, what the hell is happening?
Yeah, not even though if you look at the volume in the bottom, you don't even see a spike in the volume either.
No, but this thing, look how this thing went up, down, and up, and it maintained the volume, the whole thing on the TTM squeeze. When you see,
Oh, okay, okay.
when I saw
So
this,
that TTM squeeze, that's not the volume on top, right?
no, this is the TTM squeeze. This is the volume, but look at the TTM squeeze starting squeezing here, and then look, never here, it got like another air, like another leg up, and then whoop, and keep going up. And then when you see the clear blue, the light blue, is that it's pushing, like high, and then here's when it start fading. But when I saw this, I'm like, oh my god, we're gonna keep going higher.
Wow.
Yeah, it was an amazing move. I mean, I wasn't expecting it at all. I wasn't an SPX calls here, and I sold around this area and here. I just, if I would have hold here, it was like from here to here, the IV on SPX kind of double. So
Yeah, it ripped super quick.
yeah, but those are, hey, that's why we're here. We're trying to look that volatility. So what do we need to do tomorrow? Well, we need to be careful with this high, with this retrace here, and then if we come back here, somewhere around this area. So tomorrow, I'm gonna be careful with, I'm gonna get rid of this. I'm gonna have this level on this little peak here. This is gonna go up to here. And then I'm gonna move, this is my overnight high, whatever the high on the night is gonna go here. I do that in the morning. Overnight, the overnight low, so far it's here. If we come down, I will move it again. I got my yesterday high of the day, which is today. I'll overlap it on top of this. And yesterday low of the day, which is the low of today, it's here, and I have two overnight lows. I can just get rid of this. And this is how my chart for tomorrow is gonna look like.
I have a last question for you, Empanada. So how can you like be disciplined on a choppy day and just sitting out and not trading? 'Cause that's where I struggle a lot. Like I feel like I need to trade.
Well, I think it comes from you need to know yourself. You need to know where you feel better or more comfortable trading. I don't like choppy days because I have lost tons of money on choppy days. So out of experience, hey, if you know that, if you get your finger close to the candle and it's gonna burn, am I gonna do it again? No. So I don't care. There's one idea that we need to have, guys. there's always another opportunity. Do we have trades like today every other week? We have this is if we had $1 million and you would have bought $1 million on this move, it's life changing. But sometimes you bought $100. Maybe you did 1,000 or 5,000 or 10,000. Doesn't matter. We have this move that you can. The more experience you have, the more you practice you have, the more advantage you can take on these moves. But if you don't know what to do when these moves come, it's time wasted. That's why I encourage you to come to the lectures, to go to paper trade and be ready, because when these things come, you can make money. It can be $100. That can be the money that you need to make. It can be 10,000. Listen, a guy with $500 million on the account can buy easily 10 million bucks on this move and made another 10. So if we can make $100 on this, imagine if you have more money. So, but we need to be prepared to, make the most out of these days.
Either
So,
up or down, right?
yeah, I don't care. Like we trade any movement, but I like to weigh up just because I like my port to go up. I don't like my port to go down, and I don't want to. I don't like to be hedging, even though that's a lecture today. I don't like to hedge that much. I like my port to see green numbers and go that I have more money and I feel more relaxed and comfortable. I think that's a common rule for everyone. But you need to know first. One thing that I struggle is that I overtraded. I got my money in the first 2 hours of the day and I gave back everything, more like they can imagine, just because I felt the urge that I needed to trade every moment. And you know what? We're wrong. Statistically, the more you trade, necessarily the more risk you're taking and the more chances you are to lose. So if you made whatever amount you needed to make in the morning, get out. And then at the end of the day, that's where the volume happens. Come back, give it a couple of tries. If you're up, you add up and you're good. And if it did not go your way, just, stop and that's it. And remember, what I do sometimes when I do the one-on-ones is I tell you, grab $1,000 on your paper trade account and try to make 3 trades per day, no more. How are you gonna choose which trades are you gonna make? Because you only have $1,000. So you need to be choiceful. You need to make math in your head and see which one is gonna be the RR that is gonna be the best for you. And sometimes it's better to wait the whole morning, let the move happen, and then see where the second leg is gonna go. Like you could have this is SPY today. You could have leave SPY going until here and then grab this. This was another entry here. This was another entry here. I missed this one here. Yeah, you had another entry here. You have another pullback here, another pullback. And if you are trading on an EMA, this is the 10 EMA. We touched it, we touched it, we touched it. You got all of those entries. Just like if we go, let's look at the 2 minutes. Look at this. Look at the 2 minutes. Look, how do we touch the 20 and the 10? Touch it, touch it, touch it. Look at how many entries it's giving you. So it was a matter of having a little patience, have your levels, and that's it. So the goal is to do less trades, more efficient trades, and have time to do whatever else you need to do. We don't need to be sitting here the whole day. You can use 3 hours of your day to trade and be done. And then do like flips. You have another business, another income, you share with your family, you do something else. But we don't need to be 8 hours sitting in front of the computer to be successful traders. So I encourage you to don't feel the urge to overtrade. We don't need it. You just need to, and you don't need to. Some people I got a member today called, he asked me, like, he was kind of sad because he did not grab the whole move. We're never gonna grab the whole move. It's really easy to see this today after the fact, but we don't know what happened. Like this was going to happen, because if not, everyone would have bought 1,000 contracts of whatever they had and just sell it here. But if you grab this move here, maybe this one here, or this one here, that's okay. If you did 30%, 40% on whatever trade you did, that's amazing, guys. Remember, compound. Add it every day to your port, every day. But if you lose every time because you are over trading, you don't need that. So do a challenge with yourself. Do 3 trades per day. What's the best trade setup that you can feel comfortable trading? And just grab maybe more contracts. And instead of grabbing 1 contract every time, grab 2, grab 3. And if you're grabbing the 3 on this move, it's gonna make your whole day. Like us, if like Flips grabbed 40 contracts he wasn't 40 contracts of SPX today. So that's the difference. He doesn't need the whole move. If you trade this 15 minutes here on 5 minutes, like if he got these 3 candles at 5 minutes here with 40 contracts, he's done for the day. That's it. We don't need anything else. So you leave a runner for fun, but your trade, your main trade, it's done. That's all we need, guys. So I encourage you to do that. Don't try to overtrade. Don't try to trade every candle because you're negative or not. No, if you're negative, get out. If you're not doing it well, it's not gonna change. Just wait, see what happened, read the candles, see which indicator is the best one for you, and protect your, use stop losses. Remember, guys, you always have here, you can change these, where is it? Boom, boom, boom. I don't have my teeth here. You can change these. You can change these. You can use brackets, guys. Remember that if you have TOS, you can set up brackets and you can set up these in percentages. And every time that you're gonna get into a position, you're gonna see, I can put here 10%, 10%, and yeah, I know. We're not in the market. Every time that I click here, you see, look at on top, on the right corner and on the left corner, trigger stop loss and trigger limit with 10%. I can do this, let's say 0.5% and 0.5%. So you see, if I'm trying to grab a position, it's gonna at 0.0%, it's gonna set up it's gonna trigger automatically a stop loss and a limit. So it's gonna be triggered. You don't need to lose. You just need to click once and you have your brackets already set. You don't need to do anything. So protect yourself, use the tools that we have to protect yourself, and let's learn. We're learning every day. Any other question, guys? No? Well, DM me, guys.
Hey, Empanada,
Yes.
what do you think about AMD puts tomorrow? I see a little downtrend forming on the hourly.
Let's see. Look at the same. Look at this. Look at this range. We went down and we're back again. So are we going down? We're ranging here, ranging and up again. So I want actually this. If we stay here, I won't be surprised if we go up to 161 tomorrow. If not, we're gonna come to 153. But if the market's still positive and SPY holds what we're doing, I won't be surprised that this is gonna try to go here tomorrow. But it's gonna depend on I do my predictions. I do them on the pre-market because I know where we are. So there are different ways of knowing that. If you imagine that we set this imaginary line here, this one. I'm gonna change the color just for the purpose of this example. Here and here. Let's say that this is the pre-market. And the pre-market is anywhere. The move on the pre-market is anywhere within this. I know that we're gonna hold and break somewhere. If the movement goes a little higher, I know that probably just gonna go up. If the move is below this, we know that we're coming down. So the previous day range it's gonna give you a heads up of where we're gonna go. So I wanna see somewhere around this area of move on the pre-market to have an idea where we're gonna go. If I see this going this way, I don't know if it's coming down. I will see that maybe coming up. Or if I see this movement on this area, maybe somewhere around here and having new lows, I'll be predicting probably that we're gonna come down. So this is a nice way, like, you know, previous day range to kind of know where the price action is gonna be. So I encourage you to prove this too, so you can know how to visualize where the price action is happening. It's a great way to see it. But I do that at 8 a.m. 8 in the morning, I'll start watching what happened from 5:30, 6:30 in the morning until that time. Because sometimes we open up and then towards 9:30 we start coming down. So that's what I do it.
Would you check CVS? It's like it's back from the dead. It's bullish flow coming to
CVS. Oh, this was a buy at CVS. That's a beauty. 53 to 60. Wow, 61. Let me grab some more time. 90 days. So this is what I watch on CVS.
guys squeezing, so it should pop up.
Yeah, if it holds the here pre-market and tries to go here, you can try to, this is a $1, but this could be a little scalp trade sort of. And then, but if you stay above this area that we haven't had the whole since this gap down, is where we can try to fill this.
Yep. All right. Thank you.
Yeah, I'll keep an eye on this trend. If we keep on holding the trend and holding the trend, it's gonna come. Maybe, you know, on Thursday, we're gonna see this thing breaking up. Wednesday. If
I
it
have a
comes,
leap trade.
sorry.
Oh, sorry, bro. I interrupted you. Sorry about that.
No. You're good.
I said I had a leap trade idea. Ticker symbol is HPE. Expiration is 126.
HPD.
HPE.
Oh, P. Sorry. Hewlett Packard, of course.
Yeah, it's pretty much like a year. Yeah, 126.25, 32 call. Let me see which one this is.
The January.
No, it's 116.26. That's the ones I'm eyeing.
This was the 25, right?
26.
26.
That's 116.26.
Yeah, but what price target?
It's the 32 call.
Oh, the 32. That's what I'm looking. Oh, the 32 is the one with the look. It has a less open interest on all of them. The 35 have 10,000 open interest on those contracts. I mean, there's 10,000 holders of those contracts against this one that it cost. Look at 130 the ask versus 115 the bid. This is 420 the ask against 150 the bid. Look at the spread on that thing. $300, $320, and 9 open interest against 10,000 here. So I'll say that the better contract is the 35.
35 call?
Yeah.
Oh, right, let me mark it.
Even be like better than that one, it's the 30. The 30 is $200. It's closer to the money, and it's the spread is just $20, and it has also a lot of open interest and volume. But this one is it's too expensive. It's out of the range. Interesting.
So the 30, you said it's
The
better,
30,
200
yeah,
bucks?
the 30 or the 35 look great. It's half the
Okay.
price of the one you're telling me, and it has the double open interest.
And it has like what, 2 years?
And you have 2 years, yeah. Yeah, you can just leave that thing there and change your lease, and then remember that you have it and sell it.
Oh yeah.
Let me
Appreciate it, man.
see. Bum, 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 bum. July 9, 24. Had very good prices in general. All right, guys, 9:23, a little over. Thank you so much for your company. Thank you so much for the questions. If you have any doubts, remember, I cannot see the chat, so sorry about that. I don't know what's happening. It's blank. But DM me if you have any questions. Thank you on sharing with me for hedging. If you have any ideas of hedging, any doubts, just let me know. DM me, and have a great night.